December 2001. America's seventh largest company declares bankruptcy. $63 billion evaporate. Wall Street frozen. No one understood how it collapsed so fast. This is the story of Enron, the company that sold nothing, earned billions, and vanished while everyone cheered. Back in 1985, Enron was a boring Houston pipeline business, born from a merger no one outside Texas noticed. Then came Ken Lay, a PhD in economics with a bright tan and a brighter idea: deregulation. If the government stopped controlling energy prices, Enron could trade energy like stocks, not just deliver it through pipes. He hired Jeff Skilling, a McKinsey consultant who believed markets solve everything, especially when he was in charge. Skilling's pitch was brilliant. Enron was not an energy company anymore. It was a tech company selling the future of energy. Wall Street fell in love. Fortune magazine called Enron America's most innovative company for 6 years straight. Inside the tower, the culture was intense. Big bonuses, bigger egos, and a brutal rank-and-file system. Employees were told, "You're the smartest guys in the room. Until you're not, then you're gone." But ask a simple question. What does Enron actually do? And you'd get buzzwords, whiteboards, and a confident smile. The truth was simple. Enron sold ideas, contracts, and dreams, not actual energy flowing through pipes. By the late 1990s, its stock rose from under $10 to over $90. Everyone thought they'd found the future. Investors celebrated each quarter as if Enron was printing money. But the numbers were more illusion than reality. See, Enron used mark-to-market accounting, a method that books profits from future deals as today's income. Imagine signing a 10-year contract and counting all the money on day one. That's not optimism. That's fantasy. When those deals failed, Enron hid the losses inside special purpose entities, companies it secretly controlled. It's like selling your broken car to your dog using your credit card and calling it profit. CFO Andy Fasto built these shell entities with names like LJM and Raptor because nothing says legit like code names. On paper, Enron looked strong. In reality, it was propping up its own house of cards with borrowed money. Meanwhile, executives cashed out millions in stock options while telling employees to keep buying. Regular workers put their retirement savings into Enron 401k plans. When the collapse came, it wiped them out. By mid-2001, signs of cracks appeared. Analysts asked questions. Enron answered with slides full of buzzwords. One vice president, Sharon Watkins, warned the CEO, "We could implode in a wave of accounting scandals." Instead of fixing problems, leadership focused on PR. They believed better messaging could fix bad math. But in October 2001, Enron admitted a $600 million error. Investors panicked. Stock tanked 99% in weeks. By December 2nd in 2001, Enron filed for bankruptcy, the largest corporate collapse in U.S. history at the time. Over 25,000 people lost their jobs. Pensions worth nearly $2 billion were gone forever. Executives blamed the market. The market blamed them. But both ignored greed and a system built on trust alone. Arthur Andersen, Enron's auditor, was caught shredding documents instead of checking them. Their actions destroyed a 100-year-old firm and ended 85,000 jobs, all for protecting a client's lies. Regulators responded with new laws like the Sarbanes-Oxley Act of 2002, "Please don't lie," in legal form. It forced CEOs to sign off on their financials and made auditors act like real watchdogs. Jeff Skilling was sentenced to 24 years. Ken Lay died before serving time. Fasto pled guilty to fraud. No one won. Not the employees, not the investors, not even the market that trusted numbers too much. Enron's collapse became a case study in every business school. How ambition without integrity leads to ruin. But this story is not just about one company. It's about belief, illusion, and our need to trust success. For 16 years, Enron sold the future. People believed because they wanted to. Doubt was bad for profits. When the lights came on, the building was empty, the numbers fake, and the geniuses were gone. Remember this: trust is lost slowly, but greed destroys it instantly. Always ask where the money really comes from. After Enron's fall, lawmakers promised reform, but greed and complexity didn't vanish. They simply learned to hide better. Enron's story became a warning shot for the digital age, where innovation often outpaces regulation. The real danger wasn't the accounting trick. It was the belief that markets always reward brilliance over honesty. Enron taught corporations how to disguise debt, manipulate perception, and make hype look like growth. Today, those same lessons echo in crypto exchanges, tech valuations, and companies too innovative to fail. When hype grows faster than revenue, remember Enron, because illusions age badly under real audits. So what exactly went wrong? It began with deregulation. When the government stepped back, innovation sprinted ahead unchecked. In the 1990s, energy trading was new. No one knew how to value contracts, so Enron simply made up numbers. Each deal was treated like a jackpot. If profits didn't exist, creative accounting filled the gap. Mark-to-market was legal, but using it for imaginary future gains was like calling a sketch a finished painting. Investors loved the story. A tech-powered energy revolution, magazines wrote, ignoring that Enron barely produced real power. Analysts cheered because questioning Enron meant losing access, and losing access meant losing profits. By 2000, Enron claimed revenue of $100 billion, mostly from buying and selling energy contracts to itself. Those trades inflated numbers, creating volume without value, like a person paying themselves rent to look rich. Inside Enron, success meant short-term wins. Employees were rated and fired quarterly. Long-term stability didn't count. This rank and yank culture rewarded risk-taking, ego, and shortcuts, the perfect fuel for corporate combustion. One trader bragged, "We're not energy guys, we're deal junkies." That mindset became Enron's operating system. Andy Fasto's off-book entities masked billions in debt. Credit agencies trusted him because his PowerPoints looked impressive. Banks like JP Morgan and Citigroup financed these shell games, earning millions while pretending not to notice. Everyone involved was winning, until the math stopped working and the stories stopped selling. When analysts finally asked real questions, Enron's executives grew defensive, even mocking. "You just don't get it." That phrase became their armor. Arrogance disguising panic. Behind the scenes, cash flow had turned negative. By August 2001, Jeff Skilling abruptly resigned, claiming he wanted to spend time with family. Investors smelled smoke. The SEC launched an investigation, suspecting off-balance sheet fraud. But by then, it was too late. Ken Lay reassured everyone, smiling on camera, "Our fundamentals are strong." They weren't. They were fictional. Within weeks, employees realized their retirement funds were locked in Enron stock, falling faster than they could sell. Some employees had invested decades of savings. Overnight, their future vanished while executives flew private. "I believed in them," one worker said. "They told us we were family." Families don't steal your pension. When Enron collapsed, it took down its auditor too. Arthur Andersen shredded thousands of documents in panic. Prosecutors later called it obstruction of justice, the paper trail of one of the largest cover-ups in history. Overnight, a firm that once symbolized integrity became synonymous with fraud. 85,000 jobs disappeared worldwide. The shock rippled through Wall Street, prompting new oversight laws and ethics training across corporate America. Yet history repeats. From Lehman Brothers to FTX, new versions of Enron keep returning in digital disguise. Because the core weakness isn't technology, it's human belief that this time, it's different. Enron's leaders weren't cartoon villains. They were overconfident visionaries blinded by greed and applause. Skilling genuinely thought markets would self-correct, but self-deception corrects nothing. Ken Lay believed reputation could outweigh reality. In the end, neither survived the truth. When Fastow finally confessed, he called it creative finance. Prosecutors called it organized fraud. The contrast shows how language can turn lies into strategy until the numbers demand honesty. After prison, Fastow admitted his biggest mistake wasn't the scheme. It was believing no one would care. That arrogance destroyed thousands of lives in one of the most trusted auditing firms in the world. The Enron scandal changed accounting forever, birthing a wave of transparency rules and risk management reforms. In 2025, analysts still cite Enron as the blueprint for modern corporate deceit. The numbers remain shocking. $74 billion lost in shareholder value, $2 billion in employee pensions erased. But the bigger loss was trust, in systems, in leaders, in the idea that markets police themselves. Trust, once broken, reshapes everything. Investors became cautious, auditors became fearful, regulators became reactive. Ironically, Enron's innovation wasn't energy trading. It was storytelling disguised as finance. They mastered perception, crafting narratives where spreadsheets felt like Hollywood scripts with guaranteed happy endings. Their slogan could have been, "Fake it till Wall Street buys it." And Wall Street did, completely. For 6 years, no one wanted the truth because truth meant lower profits. The media crowned Enron a tech darling, ignoring red flags that glowed brighter than neon in downtown Houston. Journalists asked simple questions. Executives answered in riddles, jargon, and corporate poetry. We are a revolutionary energy optimization platform leveraging mark-to-market derivatives. Translation: we make stuff up. It sounded smart enough to silence critics, until the cash ran out and the curtain fell. The collapse wasn't sudden, it was slow erosion disguised as momentum. Each lie bought time, not stability. When markets finally noticed, the entire illusion imploded within months. Enron's fall showed how belief can be weaponized, how confidence without clarity becomes contagion. It also proved that ethics aren't optional accessories. They're the operating system of capitalism itself. After Enron, universities added Business Ethics 101 to every MBA program. Before that, it was an elective joke. Students learned what Enron ignored. Sustainable success is built on transparency, not tricks. In boardrooms today, executives still reference the Enron effect. Fear of losing credibility faster than profit. Some companies genuinely changed. Others just improved their vocabulary of deception. Sarbanes-Oxley Act remains the 2000s legacy, forcing signatures, audits, and accountability onto corporate egos. Yet every decade, new scandals remind us laws can't fix human ambition, only delay its consequences. From mortgage bubbles to crypto crashes, the same pattern repeats. Innovation outpaces integrity. People still chase the dream of infinite growth. Forgetting Enron proved illusions can bankrupt reality. The lesson isn't don't dream big, it's don't fake numbers to make dreams look real. Every time investors ignore basic questions, another Enron waits behind the next quarterly report. Because as long as greed outruns scrutiny, history keeps recycling the same tragedy with shinier branding. It's not about pipelines or derivatives. It's about the psychology of belief and the price of denial. Humans love stories more than spreadsheets. Enron sold the best story money could buy, until reality demanded receipts. Innovation, transformation, future, all perfect words until they become camouflage for confusion. In 2001, those words built skyscrapers of confidence. By December, they were tombstones for a generation's savings. The tragedy is how ordinary people paid for extraordinary lies. One retired worker said, "I saved 20 years for retirement. I trusted them." That sentence still defines Enron's legacy. Behind every balance sheet lies a family budget, a dream, a mortgage, things spreadsheets can't measure. When we treat finance like a game, people become collateral damage. Enron didn't just break laws, it broke the invisible contract of trust between corporations and citizens. Trust, once monetized, becomes fragile. You can't sell belief twice. Eventually, the buyer learns. The Enron story reminds us, hype fades, but consequences compound. Even today, documentaries and case studies dissect Enron like a crime scene. Every lie labeled, every motive analyzed. The takeaway remains timeless. Complexity without transparency is a red flag, not innovation. If someone can't explain how they make money in one sentence, that's not genius. That's camouflage. We admire cleverness, but ethics will always outlast brilliance. Enron's empire collapsed not from competition, but from contradiction. They believed numbers were reality, not reflection, that narrative could outweigh math. When storytelling replaces accounting, collapse is just a matter of calendar pages. Markets eventually demand proof, and proof doesn't care about charisma. The smarter you think you are, the easier it is to fool yourself first. That's Enron's final lesson. Arrogance compounds faster than interest. 2 decades later, the Sarbanes-Oxley Act still shapes boardrooms, but no law can outlaw overconfidence. New tools like AI trading and digital assets bring fresh opportunities and familiar temptations. Transparency is easier now, but so is deception. The line between them grows thinner every year. Remember Enron whenever a company says, "We've reinvented everything." Ask, including the rules? Skepticism isn't negativity. It's insurance against another $63 billion mistake. Belief built Enron. Questions could have saved it. Curiosity is capitalism's strongest audit. Always follow the cash, not the charisma. Numbers tell stories only if you read between the decimals. For 16 years, Enron sold the future. Today, its ruins still whisper one truth. Trust without proof is a liability. The next scandal will look different, speak faster, and promise bigger. But it will rhyme with Enron. Because a lie can still travel halfway around the world while the truth is tying its shoes.